guys, welcome to the program. As always, I am Irene Ubani. Today we will be talking about macroeconomic policies and how it affects you and I as individuals. Here in the studio with me is Tunji Andrews. He is a financial analyst and the head economist at Times Trade and Commodities. All right, so on the topic macroeconomic policies, what exactly is macroeconomic policies and how does it affect us as individuals?
So policies are basically decisions made by people in authority. Either it is the federal government or, as a distant arm, the government of the central bank. Macroeconomy is a study in economics where it looks at the bigger picture of the economy. So there are two broad distinctions in economics. There's the macro and the microeconomics. The macroeconomics, let me start from micro. Microeconomics looks at your spending habits.
Individuals,
individual spending habits, things that affect us on the ground, things that directly connect to you. While the macro is an aggregation of all the smaller things. So it's more like your national habits, your national employment habits, your national spending habits when it comes to GDP. So when you talk about macroeconomic policy, it's policy that affects the country from that broad perspective.
That's how we get results like inflation rate.
Hoping that somehow it affects the common man in the streets, because of course you can't divulge the fact that the little issues that of day to day are bigger on the larger context. So by the time you're able to look at them from that wide perspective, you're able to make decisions that of course can affect everybody as against small chunks within the country.
Individuals. Yeah. So you just talked about individuals, right? So how would the macroeconomic policies in my country affect me as a cobbler on the street or the owner of a store?
Okay, so I don't want to go into very detailed analysis, but I'll point out there's a law, it's called Okuns Law in economics. It basically says that if your GDP, it grows at a certain point, to a certain degree, as a direct implication, unemployment would reduce to a certain point, and vice versa. Because if GDP falls, it says that unemployment will increase. Rising. So there's a direct correlation. You can basically tie both of them into one another. Now, in that law itself, what it basically tells me is that I need to push GDP high to be able to keep unemployment low. That's just basic, right? So all my macroeconomic policy will be driven towards trying to push GDP higher so that I can have more people in employment. And of course, people who, and the economy is pretty much like a circle. And most people don't see it from that perspective. So I own a school, for instance. I don't own a school, but I'm saying as an example. I own a school. You may choose to own
your school tomorrow, right?
Yeah, maybe. But I own a school, and you bring your kids to my school. Now you pay me school fees with that. I take the money you use and pay me school fees. I used to go and buy my jacket, right? Now the person who made the jacket takes the money I used to pay him for the jacket, goes to buy a bottle of mineral. That person takes, so the economy
for every product you buy, there are materials that were purchased for.
So there's a link to everybody. If you don't look at it from that perspective, you can't be able to affect everybody holistically. So macroeconomic policy is very important because while of course we all have our individual needs, we have to take decisions for the greater good, and that's what macroeconomists try to do in terms of creating policy, and of course they translate it to the government, who then tries to enforce it.
All right, and then in terms of, I mean, when you talk about macroeconomic policies, there are certain things that it should drive, such as reduction of unemployment, like you just mentioned, increase in the economy of the country, right, and then reduction of inflation rate, for example, right. But then we have our inflation rates on a double digit in Nigeria, as it were, as at this point in time. We have our unemployment rate at 18.8%. How effective would you say that these macroeconomic policies have helped in fostering economic growth in Nigeria?
Well, you see, the thing we are very good at doing in Nigeria is creating policies or plans, so to say, the challenge we always have is enforcement, and or trying to even work through some of those policies. And sometimes we just generally just lie to ourselves. So I would say this, right? I've always tried to deny this, but I'll say it. I was part of the team that created or at least that was consulted in terms of talking about the economic growth and recovery document, because the government consulted wide. Yes, government consulted wide. In that room, I could tell, because we were in the macro end of the room. So there were people from the macro. They split us into a number of rooms, and we economists were in a room where we're dealing with macro issues. I could feel a sense of being unrealistic with some of our projections. Especially, we can look at it from the basis. And this is in hindsight. I did say it then on that table, and nobody listened to me. But the target was 7% GDP in 2019. Right now, I doubt there's no way we're going to hit 7% GDP.
The IMF recently reduced the economic growth
to
that they were expecting.
So you have to you have to be objective about your country. You have to be objective about the situation and tell yourself the actual truths to be able to get results. And what we've done over time is that we take one policy that was working in Brazil or one policy that worked in India, and we say, oh, it worked in this place, so it can work in here. No. So we've not created the right kind of policies for Nigeria. We've not created the need for policies for Nigeria, and that's why it's not working. True. It's not working because we're creating policies for other climes, while Nigeria is a very unique case. Nigeria is not...
So, feasibility study is required in terms of creating of policies.
Well, I can tell you who are the people that create these feasibility studies, but you won't like to hear it. So oftentimes the governments, and this is not just this government, this is successive governments, they tend to want to listen to foreign economists first. And when the foreign economists tell you, oh, this is what you should do, then they now bring it to Nigerian economists and tell them, localize it. Now, you're not telling the local economists to create a policy, you're telling them to localize what you've brought from outside. They'll do their best to try and localize what you've brought, even though they don't agree with it.
But the problems they are facing is obviously not what we're facing. So.
Exactly. So, and you need to find it from the local guys, because those are the guys that know what is happening on the ground. And that's the problem we've had on successive governments. And I don't think we're going to find a solution until we really sit down. Because we need to have those discussions. And for me, in my mind, the kind of discussions we need in Nigeria are not those kind of discussions you have over a drink. It's those kind of ones that if you're married, you would understand what I'm saying here. Those kind of discussions, you wake your partner up at 2 a.m. in the night and say, we need to talk. Yeah, those are the kind of discussions we need to have in Nigeria. Those kind of uncomfortable discussions where we'll be telling each other the actual truth.
They call it heart to heart.
Yeah. Those would tell us what exactly the problems are, and we'll be able to fix them.
So do you think that it's time for a structural shift in our economy?
It's long overdue. It's long overdue, especially because of the fact that the mainstay of the Nigerian economy is crude oil. France and a few other European countries have put deadlines to when they're going to stop using gasoline cars. They said we're not going to use this kind of cars anymore, or we're not going to produce these cars anymore. That shows you that the life cycle of oil, at least in its major relevance of now, is winding down to an end. But even if it wasn't, the overdependence on oil, so much so that if there's a shock in global crude oil prices, we either go into recession or something happens to us, it's a problem. It's a general problem. If you know right now, our reserves are slightly falling. Now, there's a lot of reasons why these reserves are falling. One of the major reasons is that, because we're going towards the elections, foreign investors are beginning to pull out their money and things like that. But also, we have vessels on the high sea that we've not been able to find buyers for. So we need money to keep coming in. So every time we don't have enough money coming in,
it affects the general economy.
So you can't have your economy focused on one commodity. It's not possible. You always have issues around it. And
I mean, we have agriculture now. We've always had agriculture.
We've always had agriculture,
but
but you see, the problem with agriculture is that, and of course, this is lip service, and this is the Nigerian problem, lip service. We've not told ourselves the truth. Do you know that you could go to Budapest and get mango all through the year? I'm not saying once, all through the year, mangoes. In Nigeria, it's not so. And we grow mangoes locally here. I doubt if they grow it in Budapest. What I'm trying to say is that in those places, they have storage facilities where you can get those things every day, every month of the year. In Nigeria, most of our food goes to waste.
A lot of our food in the northern region goes to waste.
So, and we don't have processing, we don't have storage. So there's no how agriculture can become a major value chain that can help Nigeria. Right now, it's just, well, what we're doing is what we call sustenance. Just farm to eat. Farm to eat. Not farm in terms of trading and thinking about, okay, we want to send mangoes.
Exporting
exactly, we're not
products.
thinking about it. So it's a problem until we start thinking about that from that scale. I don't think we're going to be able to use agriculture as a stay away from.
So what other sectors would you say, oh, this has a potential for growth for Nigeria as a country?
So I think the sector services has a major capacity to be able to help Nigeria, and that's because we have a large population. One of the things India saw was this large population, and it was able to outsource its workforce to a lot of the world, so much so that even Nigerians are going to India for medical tourism. But if you've ever been to the US, if you've called the call center service, you probably hear the guy with a slight Asian accent. He's probably in India speaking to you. But India is saying that we have a massive labor force, so they decided to create fast internet services, cable services, so that they could be able to use that. If we can harness our population, skill them, it's very important. We have to skill them. We can be able to outsource them and also use them to be able to power the economy. And of course, by that, they're paying taxes, the economy is growing, and things like that.
That's exactly the same thing Dr. Henrietta said.
So it's a general problem until we think about it from that perspective, that human capacity development is the way to build Nigeria. We will not go anywhere.
All right. We would be back after this short break when Tunji Andrews will be telling us how monetary policies and fiscal policies affect Nigeria as a whole. Stay with us. Welcome back, guys. All right, so Tunji, we really can't talk about macroeconomic policies and not at least touch a bit on monetary policies and fiscal policies. But firstly, you just have to give us like an example of what exactly is monetary policy, what is the fiscal policy, and who manages these platforms?
Okay, so monetary policy is managed by the central bank, and it's in line with managing the flow of cash within your economy. I say the flow of cash because it uses rates, interest rates, to be able to manage the level of money. Why is this important? It's because if there's too much, and I mean, the basic principle of inflation is too much money pursuing too few goods. So in trying to manage the flow of money, that it's just at the equilibrium is monetary policy. So you increase rates, you decrease rates, and things like that. You move things around. So that's monetary policy. On the other hand, which fiscal policy is managed by the administration, the government, and fiscal policy is around the management of government spending, government revenue and government spending, in terms of how I earn and how I spend.
So they're the ones taking our taxes.
Yeah, so so taxes increasing, that's fiscal policy. Also in terms of we want to reduce salaries or increase salaries, that's fiscal policy. In terms of we need to cut, people should not travel on government money, that's those are fiscal
They're the ones in charge of infrastructure as well, infrastructural development.
So on both sides, two of them marry together to fix the economy. It's difficult to work one without the other, but because fiscal policy on one side determines investment, what goes into healthcare, what goes into infrastructure, what goes into education. The more there's efficiency, the more you get results from those areas. And on this side, if money is just everywhere, it becomes useless. You want to check a place like
Just
Zimbabwe.
want to regulate that.
Yeah, you want to check a place like, I think it's Zimbabwe, where you have, I think, $1 trillion, and it probably
yes, it's
cannot
Zimbabwe.
buy. Yeah, so that is monetary policy gone mad. Do you understand? So on that side, both come together and make sure the country is working well.
Oh, okay. And then some experts have argued that as far as Nigeria is concerned, they did not see a complementary effect between these two parties, which is now having an effect on our economy. What's your take on this?
I think this is as a result, and there's a lot of things that are a result of our time as a military-controlled state, where the central bank was basically controlled by the military head of state. After we turned into, what do you call it, a fiscal civilian regime, we've never really seen that complete separation of powers between the central bank and the federal government. And they should be very different. They should be very different. The central bank should be independent. And worse off is that we've never seen any government, and I'm talking since 1999, when Olusegun Obasanjo came into, I've never seen any serious government come in and take fiscal cuts. None. Even this present administration spoke about it a lot in their campaign, but we've seen that spending has increased under their watch. So those are the kind of things that we see. Both is not even working properly, not to talk of working together to fix Nigeria. Individually, they are not working as they should.
So what issues do you think, what issues do you think is causing all of this inability to come together?
Skill. I know I'm going to get shot for this, but yes, skill. Over the last number of years, I think there's only one or two CBN governors that we've had that has really been exemplary, even though they've had some chink in their armor too. But on the federal government side, they've never just had any incentive to cut back. Never. There's no real incentive to not spend, because we don't ask questions, we don't probe, we don't say, oh, you went on that medical trip. Well, why did you do that? So it's continued that way because the people have felt comfortable with it, and I don't know, maybe in a few years when we start paying more taxes and we start demanding for our rights, maybe there'll be more accountability to the people. But for now, nothing is happening because there's no incentive for it to happen.
Which of these policies would you say would have a higher effect or a greater effect in terms of spurring economic progress for us?
So I think they're both two sides of a coin. Because the immediate thought that I want to come to your mind is monetary policy. But while monetary policy looks like it's doing that, we want to look at Nigeria. Fiscal policy has been non-existent, or at least in terms of fiscal prudence has not been existent, and Nigeria seems not to move forward. It seems like it's stagnating, and that's because monetary policy seems like it's working, but fiscal policy is not doing anything. It needs to work together. They are two sides of a coin. They need to keep. The synergy is important because while fiscal policy ensures that you are investing in the right areas to create development, monetary policy is making sure that the money is there to be able to fund that investment. So
which would in turn boost economic growth,
exactly, and then give more monetary policy. So it's working hand in hand. If one cannot work without the other.
All right, and lastly, how do you think politics is influencing our macroeconomic policies today?
Well, you see, you can't divorce politics from everything. I mean, even if you look at America, Make America Great Again, Donald Trump. His whole America First stance is affecting policy.
It's trickling down, yes.
Yeah, it's affecting macroeconomic policy. And that's because his thoughts are, this is where America should be. Even Nigeria, the present administration sees governance in a certain way, and that is affecting policy stance.
So it's a case of politics influencing the policies of a country.
It does.
The policies
it does.
is
Always.
trickling down a
Always.
positive effect on
Always.
citizens.
So the federal government, this particular administration, has a quote-unquote anti-corruption stance. That is affected a lot of things, or is influenced both for good and for bad, right? You just can't take it away. You can't take it away. Even the person of the president affects macroeconomic policy because it's like he's at the top, he directs everything.
As much as you don't want to think about it.
But he's at the top. So it's important that we pay attention to the politics because somehow it affects macroeconomic policy.
All right, and lastly, Tunji, I want you to define any macroeconomic term for us, any of your choice.
Anyone?
Yes. Anyone.
Okay, so so GDP is probably the most famous one. That's gross domestic product. It is the total value of goods, the total final goods and services consumed within a certain period of time within your economy. So, so for instance, your dress, you buying it, you were the final consumer, adds to GDP. So before your dress was made, there was the thread, there was the fabric, there was the dye. All those things are factored in, but they don't contribute to GDP. Your buying it off the shelf was the final contribution to GDP. So yes, it's the final.
So the more we buy from us, the more we increase our GDP.
Yeah.
Then
also,
more we import, we're sort of.
Yeah. So GDP also does that. It kind of takes your imports away from your exports. So also when people buy from you, it also adds to GDP. So I mean, it's generally a case of final goods and services within your economy in terms of how the total calculation of it is what is GDP.
All right, thank you very much,
Tunji,
for joining me on the program today. And that will be all on the program for today. Do have a nice day. Bye.